Hello and greetings to all. This is Sundaram Mutual's monthly debt market view. India's active COVID-19 cases towards a month end were down by around 19%. This is from the peak seen in early May during the second wave, with some states showing even bigger fall. This has created space for relaxation and allowed mobility indices to rise to a fresh highs post outbreak of COVID-19. And soon we may see close to pre-COVID-19 levels. On vaccinations at the month end, more than 50% of the adult population had received at least one dose, and the pace of vaccination is at all-time high, record high. Fixed income markets were relatively subdued as participants awaited the outcome of the Monetary Policy Committee meeting in the early part of the month, which was status quo. Later, some softening in the crude oil prices, good GST collections for July 2021 marginally supported the yields. But the outcome of the MPC meeting, where we had first dissenting member, led to some dampening of enthusiasm. The yield of 10-year benchmark traded in the range of 6.19 to 6.25 and closed one basis high at 6.21 compared to the last month. Corporate bond yields in 1 to 5 year segment rallied by 10 basis point, whereas the longer end of the curve rallied by 3 to 4 basis point. However, in the week following, the first week or so of month of September, we saw a good extension in the rally. Another much anticipated event was Jackson Hole Symposium. The Federal Reserve Chair of US announced the idea that tapering is likely to be announced later this year in an otherwise very neutral speech. The precise timing has not been announced, and such prospective action also has some caveats in form of uncertainties related to pandemic and the evolution of the labor market in US. Further, it's been made amply clear the end of the asset purchases will not mean start of the rate rises. There will be serious time gap between the both. Globally, some other major central banks such as Bank of England and Bank of Canada are already on the path of tapering. A few central banks in emerging markets like India are still diverging with no changes in the use of their unorthodox bond buying programs as of now. Second important development is a lower than expected CPI number at 5.6 versus 6.3 last month. This gave partial respite to the fears that RBI can fall behind the curve in a big way. They were forcing a remedial action later, harsher remedial action later. There still remains a possibility as drivers of inflation have kept swapping from supply side frictions to food, fuel or commodity. And this poses a risk of getting entrenched into a headline CPI number. It is clear, it is also clear that RBI would not like to, spook the market, or is likely to err on the side of caution rather than risking the financial stability and national economic recovery, which is here right now. From here onwards, we can see a bit more serious steps. I would say a bit more serious steps to at least manage the system liquidity, which has seen a record high at 7.42 trillion in month of August. This can be in form of additional VRRs or reverse repos or other steps, as this can be the precondition to introduce any kind of reversal of the policy, loose monetary policy, which is here right now. The aim here would be to bring the overnight rates near the reverse repo rates. Also, there is a growing acceptability right now to the idea that record high system liquidity and the measures which were introduced at the time of peak of the pandemic in last year are no more required and are not helping the credit growth in any way, which is visible in the numbers. And more importantly, right now, one should look at the long-term rates, as these are the rates which matter more for the credit growth in early economic recovery cycle. By doing some rebalancing growth inflation priorities right now, RBI can reduce the possibility of a harsher action later. Improving fiscal situation, a drop in CPI on one side, impending normalization of extraordinary monetary policy on other, would mean that though longer end may remain supported for some time, but short end of the curve in coming quarter may see some gradual upwards move, leading to the flattening of the. These actions are forced by need of providing relief by limiting the excess bond supply, which is the result of hit on government finances during the pandemic. And the aim here, as we know, has been stated by RBI many times, is managing the orderly evolution of the yield curve, and we can read it as term premium. Now, the challenge with this would be to time the eventual weaning off from large-scale bond purchases and reversal of extraordinarily easy monetary policy in a fashion so that it won't lead to higher premiums in longer-dated government bonds. This is possible because as of now, central banks remain in whatever it takes more to support growth. But such gradual reversal will also be helped if government debt dynamics turn sustainable and inflation pressure ease off and the headline numbers come within the MPC's target range. On both these fronts, we have had positive development in last month. The April-July fiscal deficit number was at 9-year low. Gross tax revenues are growing by double digits, 13.6% on a 2-year CAGR basis. Both direct and indirect taxes collections have shown improvement, and it's not just only the excise number which is showing this growth. This creates a possibility of actual fiscal deficit meeting the target and even lower than that. Crucial thing here would be to look out for the divestment proceeds. If they can match the budgeted numbers, then definitely we'll have this possibility and a possibility that we'll have some cushion for any unexpected shocks later in the year. The problem faced by fixed income investors today is who are already facing negative yield is how to play the markets right now in these uncharted territory, where on one hand we have system liquidity pushing down the short-term rates very low. On the other hand, there is a build-up of high inflation expectation and also expectation of reversal of extra accommodative monetary policy in the long end of the medium to long end of the curve, leading to the steepness in the curve. Here, one would be inclined to invest fully in the longer end of the curve to have better carry yields to start with, but this strategy is fraught with timing risk. As we know, we can be at sniffing distance from the reversal of the current EC policy. On the other hand, if you are investing fully on short end of the curve right now and want to wait for the rates to go up, this may or may not work and can leave one with very large carry losses on the yields. So our overall advice to investors would be to match up their investment horizons with the duration of the funds and select the strategies which reduce the inherent risk in the portfolio by offering some cushion in the form of roll down gains. Finally, as we cannot ignore the medium to long end of the curve because the substantial spread is there and inherent protection is provided by that up to a level to investor in case of possible yield rise. So a strategy where a systematic deployment can be done in short to medium end of the curve in a rule-based way with the objective of managing risk and providing reinvestment opportunities to investors at a higher yield in later rate rather than having a lopsided approach supported by one's view on one particular segment of the curve can also be a prudent way to play the market at this time. Sundaram Banking PSU is offering one such strategy which investors can look forward to. Thanks, and that would be all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.